how does a real estate developer um, pull off like a 500% revenue increase in a single quarter, more than double its gross profit for the first half of the year, and somehow ended up reporting a worse bottom line than it had 12 months ago?
It sounds like a glaring typo on an earnings release,
Yeah.
honestly. Yeah. But when you pull up the interim condensed consolidated financial statements for Ramz Real Estate Company for the period ending June 30, 2026, those are the actual reported figures.
Well,
It's basically a masterclass in how mark-to-market accounting can completely obscure the operational reality of a business.
it's wild. I'm Hassan, by the way.
And I'm Zinab.
And today's deep dive is dedicated to, just stripping away that accounting noise. We are really analyzing Al Rams's second quarter and first half results to uncover what is, frankly, a massive operational pivot that's hidden in plain sight.
Exactly. Because for anyone who just, skims the headline numbers, the narrative here is incredibly contradictory.
It makes no sense.
It doesn't. So our mission today is to wade into the mechanics of their cash flow, examine a rather aggressive related party transaction, and, calculate the true operational heartbeat of this company.
Yeah, because the surface level data absolutely sets a trap for the casual investor. The top line growth is so aggressive, it's like it demands immediate attention, but then the net income tells this whole story of contraction.
Right.
So let's put the sheer scale of this revenue explosion on the table first.
Sure.
Looking purely at the second quarter, Q2 of 2025, Al Ramz brought in a modest 89 million Saudi riyals. Fast forward exactly 1 year to Q2 of 2026, and that revenue line ballooned to over 550.3 million riyals.
Which is,
That is more than a 500% jump in 3 months.
yeah, it's massive.
Hmm.
And zooming out to the first half overall, combining the first and second quarters,
Yeah.
the trajectory holds. First half 2025 revenue set at 222.8 million rails.
Okay.
That figure rocketed to 910.6 million rails in the first half of 2026.
Yeah.
Consequently, gross profit scaled alongside it, moving from 36.3 million to 87.4 million rails.
But see, I want to pause on those gross profit numbers for a second before we hit that net income paradox we talked about. Because the margins are telling a subtle story here.
Mhm.
Gross profit doubled, yes, going from roughly 36 to 87 million, but the revenue quadrupled.
Right.
That means the margin profile of the new revenue they're bringing in is significantly lower than what they were doing last year. Like they traded margin for massive volume.
That is a really critical observation, actually. And it hints at a major shift in what they're actually selling, which, we'll unpack shortly. But the immediate puzzle is further down the income statement.
Yeah.
Because despite that massive top-line influx, net income in Q2 dropped from 64.9 million rials in 2025 to just 25.6 million rials in 2026.
It's just crazy to me. And the 6-month view isn't much better, right?
Mm.
Full first half net income fell from 71.5 million down to 54.3 million. You see sales going through the roof, gross profit doubling, and then the final grade at the bottom of the page is undeniably worse.
Well, the culprit here is entirely disconnected from their core operations.
Okay.
To reconcile this paradox, we have to isolate a really specific line item. It's called unrealized gains from investments at FVTPL, fair value through profit or loss.
Right.
Because they hold substantial investments in real estate funds, any fluctuation in the market value of those funds hits their profit and loss statement immediately, even if they haven't sold a single unit.
The mark-to-market distortion. We're looking at paper gains violently swinging the net income.
Exactly.
Let's trace the math on this to see the actual scale of the distortion. So in Q2 of 2025, Al Ramz recorded a massive 67.5 million rial paper gain on these FVTPL investments.
The funds they were invested in
Yeah.
experienced this wild upward revaluation during that specific 3-month window.
Yeah.
And that 67.5 million was injected straight into their net income.
But then in Q2 of 2026, the market cooled off. That paper gain was only 13.1 million rials.
Yeah.
So the 2025 net income was artificially inflated by an investment spike. None of that 67.5 million came from pouring concrete, finishing developments, or closing sales with home buyers. It was just the portfolio looking highly lucrative on paper.
Which means if we want to understand the health of the actual real estate business, we really have to recalculate the bottom line.
Okay, yeah.
We need to strip out the unrealized paper gains, add back any realized investment losses, and essentially isolate the normalized earnings.
Well, I've actually got the math right here, and the outcome completely rewrites the company's narrative. Let's isolate Q2 first.
Okay.
In Q2 2025, they reported that 64.9 million real net income. When we subtract the 67.5 million in paper gains, it reveals that the core operations didn't make a dime. They actually operated at a loss of roughly 2.5 million reals for that quarter.
Wow. So the headline looked incredibly healthy, but the operational engine was actually stalling out.
Exactly. Now apply that same normalization to Q2 of 2026. They reported a much lower net income of 25.6 million, but subtracting the smaller 13.1 million paper gain leaves a normalized operational profit of 14.7 million reals.
That's a huge swing. Year over year, the core business swung from a 2.5 million operational loss to a 14.7 million profit in a single quarter.
It's the ultimate lesson in why headline investing is dangerous,
Definitely.
We can run the same calculation for the first half overall to see the macro trend. First half 2025 reported 71.5 million in net income. Strip out the investment noise, and the normalized operational profit was a meager 4.7 million reals.
Right. And for the first half of 2026, taking the 54.3 million net income and removing the investment gains leaves an operational profit of 42.4 million reals.
A leap from 4.7 million to 42.4 million. The core business profit grew nearly tenfold.
Yeah.
It's like evaluating someone's financial health by looking at their net worth during a housing bubble.
Oh, this is a good way to look at it.
Right. In 2025, they looked wealthy because, Zillow said their house appreciated, even though they were secretly losing money on their day job and burning through savings. But then in 2026, the house price stabilized, so their net worth didn't jump as much, but they got a massive promotion, and their actual take-home pay skyrocketed.
That is exactly what's happening. And that day-to-day cash generation model is what we need to focus on next.
Yeah.
I mean, that tenfold increase in operational profit demands an explanation.
Oh, totally.
Where did 910 million reals in revenue come from in just 6 months?
Especially considering their traditional revenue engine seems to be sputtering, honestly.
Yeah.
The financial notes show their off-plan sales dropped significantly, falling from 139.7 million in the first half of 2025 down to just 49.6 million this year.
So the growth entirely stems from a new category. If you look closely, the biggest driver in the first half of 2026 is listed as real estate under development sales.
Okay.
And that injected 540.7 million reals into the top line. That category generated literally zero revenue in the first half of last year.
Going from 0 to 540 million reals means a fundamental pivot in corporate strategy. I mean, digging into notes 10 and 17 provides the context here.
Yeah.
They achieved this by selling off massive plots of land in Riyadh and Jeddah. But they didn't just place these assets on the open market, they sold them to Aud private real estate funds, specifically Fund 1 and Fund 2.
Right. And the critical detail here is the counterparty. Aud Capital manages those funds, and Aud Capital is an associate company of Ramz.
Oh.
Yeah.
Right.
This is a massive related party transaction. They moved over 550 million reals worth of land off their direct balance sheet and into funds managed by an entity they have a very close relationship with.
Oh, wow. That immediately explains the margin compression we noticed earlier. Bulk selling raw or partially developed land to a related fund is generally, going to yield a lower gross margin than selling finished off-plan individual units to retail buyers.
Exactly. It shifts the business model from retail development to wholesale asset rotation. But, I mean, the most staggering part of this transaction isn't the margin, it's the settlement method. Ramz recognized over 500 million reals in revenue, but no cash actually changed hands.
Yeah, I had to read that footnote like 3 times.
Oh, no.
They are settling the 550 million real land sale through the issuance of in-kind units in those exact same Aud funds. They essentially took subscriptions in the buyer's fund as payment.
Yeah, from a purely accounting standpoint, the revenue recognition is standard, the asset changed hands, economic value is exchanged, and the top line gets a massive boost.
Sure.
But structurally, they are converting direct real estate assets into financial securities.
It's the equivalent of selling your vintage car to a colleague for 100 grand, booking the profit to look great on your tax return. But instead of him writing you a check, he hands you a 20% equity stake in his new startup.
Exactly.
You're wealthier on paper, but you can't use that equity to buy groceries or pay your mechanics.
And this is where that accounting quirk collides violently with reality. A company cannot pay its contractors, its employees, or service its debt with in-kind fund units.
No, definitely not.
When the primary driver of a 910 million real revenue haul is a cashless transaction, The income statement kind of loses its utility. We have to pivot directly to the cash flow statement to see if the business is actually viable day to day.
And the operating cash flow paints a pretty stark picture of that liquidity reality. For the first half of 2026, net cash used in operating activities is negative 119.3 million rials. They are burning cash.
They are. Though it is worth noting that a 119 million rial burn is a massive improvement from the 331 million rials they burned in the first half of 2025.
Fair point.
Last year's burn was likely driven by heavy capital expenditures, acquiring the very land they just sold. But the current burn rate is inextricably linked to the odd fund deal.
Yeah, you can see the exact footprint of the cashless deal in the working capital adjustments. Trade receivables absolutely ballooned by 587 million rials.
Yep. The 550 million they are owed by the odd funds is parked in receivables, just waiting to be legally converted into those fund units. It creates an enormous short-term drag on operating cash flow.
It really does.
The revenue is recognized. The operational profit looks fantastic after our normalization, but the actual cash to offset the physical expenses of running a development company simply isn't there.
Which introduces a glaring contradiction when you look at the statement of changes in equity. Despite an operating cash burn of 119 million reals, Ramz paid out a 75 million real cash dividend to shareholders this year.
Yeah.
You cannot distribute cash you aren't generating from operations without, tapping into external lifelines.
And the financing section of the cash flow statement holds the answer to that. To maintain liquidity, fund their ongoing developments, and cover that 75 million real dividend payout, they are leaning really heavily on debt.
Right.
During the first 6 months of 2026, they drew down 334.9 million reals in new long-term borrowings.
Wow. Taking on a third of $1 billion reals in new debt in just 6 months pushes their total loan principal up to 875.2 million reals.
Yeah, they are utilizing Sharia-compliant bank facilities, likely Tawaruk or Mirabaha structures, to bridge the working capital gap. These facilities provide the immediate cash injection required to replace the liquidity they didn't receive from the old land sales.
But borrowing high-cost debt in this macro environment just to hand 75 million back to shareholders feels like a very precarious balancing act. You are financing a dividend while your core business is generating in-kind equity units.
It is a calculated, albeit pretty aggressive, corporate signaling strategy.
Okay, how so?
Well, think about it. If Ramz halts its dividend while simultaneously publishing a press release boasting of 910 million in revenue, retail shareholders and institutional investors alike would panic.
Oh, true. The optics would be disastrous.
Exactly. By leveraging their balance sheet with bank financing, they buy time. They keep the market confident while waiting for the art funds to mature or for their traditional off-plan sales to recover.
So they are essentially betting that the long-term yield and capital appreciation of those out fund units will significantly outpace the finance costs associated with carrying 875 million rials in debt. It is a massive leverage bet on their own associates' fund management capabilities.
It fundamentally changes their risk profile. And speaking of risk, the financial notes outline a specific contingency that threatens to undermine the operational progress we calculated earlier.
Yes. Note 20.2. It details the exposure to the white land tax. So Ramz received 94 separate invoices from the government, totaling 35.3 million rials for fees on undeveloped land in Riyadh.
And just for context, the white land tax is designed strictly to penalize land hoarding in urban centers.
Yeah.
By imposing fees on idle plots, the government forces developers to either build or sell to someone who will.
Right. And a 35.3 million rial invoice is severe. But what really stands out is that Ramz hasn't provisioned for this liability on their balance sheet. They haven't taken the financial hit, basically assuming they won't actually have to pay it.
Their defense rests entirely on the classification of the land. They're formally appealing the invoices, arguing that these specific plots are actively part of approved development projects.
Right.
So the legal argument is that the land isn't white or idle. It is actively moving through the regulatory and construction pipeline.
But if the relevant authorities reject that appeal, the math becomes really grim. Let's look back at the normalized operational profit for the entire first half of the year. We calculated it at 42.4 million rials.
Yeah.
If they are forced to pay a 35.3 million rial tax bill, it wipes out over 80% of their operational profit in one stroke.
It is a binary regulatory risk hanging right over the income statement. A successful appeal validates their development pipeline and protects their margins.
Right.
but a failure fundamentally resets their profitability for the year. It's a metric that just demands close monitoring in the upcoming quarters.
So, pulling all of these threads together, the intern statement reveals a company undergoing a radical metamorphosis. We started by looking at a confusing set of headline numbers, but the underlying mechanics show a business pivoting sharply.
Very sharply. Ramz is transitioning away from relying on the passive mark-to-market windfalls of the FDLKPL investments that defined their 2025 results. They've engineered explosive top-line growth and a tenfold increase in normalized earnings. But they've done it through a really aggressive, complex strategy.
Yeah, because the growth is entirely dependent on related party transactions. They are trading physical land for financial units in the out funds, basically sacrificing immediate cash flow for long-term equity exposure. And to survive that liquidity gap, they are scaling up debt to keep the developments running and the dividends flowing.
They are operating a highly leveraged engine. The revenue is real, the asset transfer is real, but the cash dynamics require them to walk a very tightrope between debt servicing and the future performance of those fund units.
Which leaves us with a fascinating strategic question to really mull over. By accepting fund units instead of cash for over $500 million in real estate, Ramz has permanently anchored its balance sheet to OutCapital's performance.
Yeah.
As those funds acquire more land, develop it, and hopefully appreciate, Ramz's investment portfolio will swell. So, are we still analyzing a traditional real estate developer that survives by laying bricks and selling homes?
Good question.
Or are we watching the real-time evolution of a company quietly transforming itself into a massive, highly leveraged real estate asset manager, using its own developments merely as seed capital for its investment funds? It is a structural evolution that completely redefines how we should value the company going forward. Definitely something to chew on until next time.